The gas prices on your app this morning are not the same as yesterday. They will not be the same tomorrow. And the reason is not a pipeline. It is not a policy. It is a strait of water less than 40 miles wide on the other side of the planet that is now, for all practical purposes, closed. 8 million barrels a day. Gone. Not delayed, not rerouted. Gone from the global market in a single month. That number is not an estimate from a think tank or a projection from a hedge fund. It comes from the International Energy Agency, the body that tracks the flow of energy across every major economy on Earth. And they're calling this the largest oil supply disruption in the history of global markets. Not this decade, not this century, ever. But the real weight of that statement only becomes clear when you understand what was flowing through that water before the war began. The Strait of Hormuz is a choke point. That word gets used often, but rarely with full precision. 20 million barrels of crude oil and refined petroleum products moved through that passage every single day before the conflict escalated. That is one in every 4 barrels traded at sea anywhere in the world. Iraq, Kuwait, Saudi Arabia, the UAE, Qatar, their oil leaves through that strait. It has no other viable path at this scale. And when military operations against Iran began, the strait did not slow down gradually. It did not reduce in stages. It collapsed. Flows dropped to less than 10% of normal levels within days. A waterway that moved the energy equivalent of the entire American economy's daily consumption is now operating at a trickle. That alone would already be serious, but something larger is happening underneath the surface, because it is not just the oil that stops moving when a strait closes. It is the entire industrial logic built around the assumption that it would always be open. Gulf producers have not simply cut exports, they have cut production. Storage is filling. Tankers are unwilling or unable to load at port. The countries bordering the Persian Gulf collectively lost control over at least 10 million barrels a day of total output capacity. The world did not lose access to a pipeline, it lost the operational reality of the most important oil-producing region on the planet. Brent crude, the global benchmark, crossed $120 a barrel. It pulled back briefly after emergency announcements from major governments. Then attacks resumed on commercial shipping in the region. Then a major export terminal had to be evacuated. The price moved back above $100, and it stayed there. This is the point where a regional war becomes a pricing mechanism for the entire planet. That is not rhetoric, it is arithmetic. When 8% of global oil supply disappears inside a single month, prices do not adjust slowly. They do not wait for diplomatic signals or ceasefire negotiations. They move immediately, because energy markets price the future, not just the present. Every airline, every shipping company, every logistics network, every manufacturing operation that depends on diesel recalculates its cost structure in real time. That recalculation reaches your gas station, your grocery aisle, and your electricity bill before any peace proposal is even drafted. The International Energy Agency did not sit still after the disruption began. Its 32-member governments unanimously agreed to release 400 million barrels of oil from their emergency strategic reserves. This is not a routine action. It is the largest coordinated reserve release in the history of the organization, more than double the 182 million barrels released after Russia invaded Ukraine in 2022. The United States alone committed 172 million barrels from the Strategic Petroleum Reserve. Japan announced it would begin releasing its share within days. Germany confirmed compliance. The move was designed to send an immediate market signal and to buy time while military and diplomatic efforts play out. But here is what matters.
The IEA itself warned that the release may not be enough. 400 million barrels sounds enormous, and by any historical measure, it is. But the math is unforgiving. At 8 million barrels of daily loss, that reserve covers roughly 50 days of the current supply gap. If the strait remains blocked beyond that window and production does not recover, the emergency stockpile becomes a bridge to nowhere. The agency was direct about this. The reserve release is a temporary measure. The actual solution is the Strait of Hormuz reopening, and that depends entirely on when and how this war ends. Neither of those answers is available right now. Now think about what this means for the American consumer specifically. The United States produces more oil today than any country in recorded history. That is a real fact. But American production does not insulate American consumers from global oil prices. It never has. And the reason is structural. Gasoline is priced against the global crude benchmark because American refiners sell into a global market. When Brent climbs, pump prices follow. The connection is direct, automatic, and fast. Goldman Sachs has already revised its United States inflation forecasts upward in response to this disruption. Higher energy costs flow into freight costs, which flow into the price of everything that moves on a truck, which is almost everything Americans buy. Diesel faces a particular problem inside this specific disruption. The IEA flagged diesel and jet fuel as the most vulnerable refined products in the current crisis because of how refining capacity in the Middle East is geographically concentrated. More than 3 million barrels a day of regional refining capacity have already been shuttered due to attacks and the absence of viable export routes. Another 4 million barrels of capacity remains directly at risk. Diesel powers agriculture, it powers construction, it powers the backbone of American supply chains. Jet fuel powers the aviation network that connects every major American city to the rest of the world. When those products tighten, the cost cascades into places that have nothing visibly to do with oil prices. The broader economic picture is already starting to shift. The IEA cut its global oil demand forecast for the year by roughly 25%. That is not a signal of economic collapse, it is a signal of suppression. Airlines are canceling routes across the Middle East and reducing schedules on long-haul routes elsewhere to manage fuel costs. Demand for liquefied petroleum gas is falling as supply chains through the strait have been severed, affecting not just vehicle fuel but industrial feedstocks and home heating across parts of Asia and Europe. The global economy was already navigating elevated interest rates and slowing growth before February. This shock is arriving into a system that does not have much cushion left. On the supply side, there are partial offsets, and they are real. The United States, Canada, Brazil, Kazakhstan, and Norway are all producing more than anticipated heading into this year, and those increases are meaningful at the margins. But they cannot replicate the concentrated volume that was moving through those 40 miles of Iranian coastline every single day before the conflict started. The IEA revised its full-year global supply growth estimate from 2.4 million barrels a day down to 1.1 million. The projected global surplus, which only months ago looked like a record glut that would hold prices down through 2026, has been cut by more than a third in a single report. What that means in plain language is this. The energy market entered this year with a cushion. That cushion has not disappeared entirely, but it has been cut significantly and it is still shrinking. If the conflict continues to escalate, if attacks on tankers and terminals persist, if the strait remains functionally closed through the second quarter, the surplus does not hold. It becomes a deficit, and markets price that scenario before it actually arrives. The deeper issue is this.
American military and diplomatic assets are currently focused on the operational phase of the conflict. The Navy is not yet in a position to escort commercial tankers safely through the region at full scale. The expectation is that this changes, but expectations and timelines in active military conflicts are not guarantees, and the market knows this. Every statement from Washington about falling prices and rapid resolution has been met with brief optimism, followed by a return to the data when the underlying supply problem does not change. This is what energy markets do when the problem is structural rather than psychological. They absorb statements and then look at the numbers again. One way to understand the scale of what is happening right now is to look at how markets have historically responded to large supply disruptions. The 1973 Arab oil embargo removed about 5 million barrels a day from global supply. It triggered a quadrupling of oil prices, a recession across the developed world, gas rationing in the United States, and a fundamental reordering of American energy policy that lasted decades. The current disruption, at 8 million barrels a day, is larger than that event by volume. The global economy is also larger now, which provides some buffer.
But the speed of modern supply chains, the interconnectedness of global logistics, and the degree to which just-in-time production models have eliminated inventory buffers mean that the transmission of an energy shock into consumer prices is faster today than it was in 1973, not slower. That context matters because it tells you this crisis is not a temporary price spike waiting to resolve itself. It is a structural event that will leave marks regardless of how quickly the military situation stabilizes. 8 million barrels a day removed from global supply in a single month, the largest emergency reserve release in history deployed to buy time. Pump prices already responding, inflation forecasts already revised, refinery capacity at risk, diesel supplies tightening, jet fuel under pressure, a global cushion that is shrinking rather than growing, and a narrow passage of water that remains, as of today, still largely closed. This crisis is not peaked, it is still defining its own shape. Every week the strait stays closed. Every week tanker traffic remains below normal. Every week Gulf producers cannot restore full output. The cost of that definition rises for everyone. For American consumers at the pump, for businesses calculating freight costs, for governments trying to hold inflation down while managing the fiscal cost of reserve releases and military operations simultaneously. The number that started this conversation is 8 million barrels, but the number that ends it is not a number at all. It is a question. How long does this last? And that answer is still being written right now. If you want to follow how this develops and what it means for energy markets, inflation, and the global economy, subscribe and stay close. There is significantly more to cover here, and none of it is resolved.